Hi guys, welcome back to the channel. If you could help me like and subscribe, that would be really great. Today I just want to talk about some of the option yield ETFs that have been getting popular lately, and how to actually do it yourself if you're a maybe you're a larger investor. So just kind of like the problem statement, like right now, even though the market is technically still up for the year. Um, like during the summer months, like the market's been really, the performance hasn't been that great. It's kind of saggy, but maybe it'll pick up during the fourth quarter. So some stocks are still expensive, and like the yields are not that great, and I think that's why like these option ETFs are really popular. So I'm really excited. Like for like Yieldmax and Defiance, and I think there might be a few other ones, such as Global X and Neos, um, that have like these option-based ETFs, and where they're either selling calls or selling cash secured puts, and then they're passing along the yield in a form of monthly dividends, and that's key because most stocks they're on a quarterly basis, and the stocks that are that pay out monthly, their cash flows aren't that great. So sometimes like the the performance like overall hasn't been that good. But these option-based yield ETFs, um, I think there might be a floor to them. Like meaning like you won't like the there's no such thing as a safe investment. But I don't expect these type of ETFs to tank let's say like 50 to 90% unless like the market itself or the underlying stock tanks. But even if there's a lot of volatility, you might be able to get back some of your initial investment in the form of dividends, and like if you compound like your dividends back into the ETF itself, you know, I could see these being like a good potential long-term hold. But anyway, that's just my opinion. So I don't want to color your own investment opinion. So I've started some trial positions. I've started with NVDY because that seems to be like the kind of like the hot stock at the moment. Even though like the AI hype has died down a bit, they're um, well so far like they've been able to maintain the revenue growth, and they should still be okay up until like Q1 of 2024. But again, that's just based on my reading of like their fundamentals. But again, that's subject to change. And the NVDY I like because like this ETF itself, even though it's based on their the options, like it also has like its own options chain, so you can actually sell cash secured puts on like NVDY. Um, and then like once you get assigned the ETF, then you can continue selling covered calls against it itself, while the fund itself pays out like a monthly dividend. So it's pretty wild. Um, and I like so far the triple QY, because this is the first I believe like the first 0 day DTE. Um, so I'm waiting for like the payout and that's just to see how it goes. And because like all these funds are relatively new, so they don't have much of a track record. So I want to see how they do. Like if we have a really deep correction, like 10% or more, in the overall market. So we'll see. And then there's also the Coinbase. By the time you watch this, like it'll probably be out, and they've already paid out like their first dividend. But I want to show you guys like how they actually do it. Uh, so so this is the fine print. So like you can get this like when you actually buy the ETFs itself, your broker will probably send you a prospectus. And if you read through, like basically for like some of these ETFs, like they're based off of a covered call, but not on the stock. It's actually on the synthetic position. So basically, a synthetic long, for example, would be a long call plus a short put. Um, and then if you go down to like some of the other materials, so this is the like kind of like the Yieldmax ones, like they have a whole bunch of them, and there'll probably be more by the time you watch this. So far, um, like if you look at the anticipated distribution rates, like these are pretty good. Like even if you look at the lowest one, like Google, for example, I mean 22% in a month. Excuse me. This is 22% over the course of a year. But again, these distribution rates are subject to change because like each month, like the your option premiums will fluctuate just based on like the volatility of the trading in the stock itself. So you can't expect these distribution rates to stay the same. And the reason why I like Coinbase so far, um, yes, it's about 75%, but you can't expect that to stay at 75% because let's say the SEC just continues delaying like the Bitcoin ETFs, and then that might cause like the excitement around like any crypto based asset to kind of like the implied volatility to go down, and then the distribution rate could go down. But of course, like if you think that maybe an approval of a Bitcoin ETF could spark a crypto rally, this could be like a good way to play it, especially if you have a small relative balance. So the reason why I wanted to show you guys how to do it yourself because at some point, even if you have a small account, if you keep compounding your gains, especially if you get your dividends on a monthly basis, it could actually snowball to relatively large amount, within a few years. So once you get to like to a larger size account, you can actually benefit from trying to replicate the strategy yourself by using a combination of stock replacement and then options. And if you go back, like if you notice, like most of these stocks don't really pay a dividend. And then the ones that do pay a dividend, like for example, Apple, NVDY, um, yeah, that's pretty much it for these guys. I think they also have a Microsoft one, but again, like the dividend based on the stock alone isn't that much. So these ETFs, like a lot of people call them game changers, so I don't want to hype it up too much. But I think these could really make a difference. If you already have like a dividend based portfolio, and these this could actually help um, boost your returns on your portfolio. But of course, like the past performance isn't a guarantee. So, um, but let's see how it goes. So for example, at the time of this recording, Coinbase like 400 shares is almost $75. So that's almost $7,500 if you decide to just buy the shares and then just do like covered calls every week. But if you want to go out to let's say like the January 2025 expiration cycle, because this will be like over a year, in this way like if you hold it for that long, uh, you could potentially get like a nice some capital appreciation, and then if you just when it's time to exit the position, you qualify for a long-term capital rate tax if you're a U.S. based investor. So that could make a difference in like the overall return after tax returns. So for example, let's for the sake of this example, I'm just going to use a 70 strike out in the January 2025 expiration cycle, and I'm using like the worst case scenario. So basically, if you wanted to buy this particular call at the 70 strike, you would have to pay 28 40 times 100 because each option is worth 100 shares. So you have to multiply this price by 100, and that gets you to this 2,840 over here. And then also, to complete like the stock replacement, you're shorting a put in addition. So if you sell at the um, at the worst possible price. Like if you sell at the bid, so meaning um, you're selling at this $20.05. That's 2005. Normally, if you're trying to do this yourself, you want to try to get in the middle or as close to the middle of like the bid and ask, just so you can get a better price. But just for this, let's say like you're in a hurry or you're new and you just want to get the trade done. That's fine. And again, this is just an example. So then, like if you take like the price of the long call less, like what the premium that you get from the short put, that gets you to 835. Uh, and that's just like your initial upfront cost. Because don't forget, like if when you short the put, you're creating an obligation for yourself. So your absolute maximum, like worst case scenario is like your 7,000. Let's say like the Coinbase goes out of business or the SEC bans them or whatever. Like the worst possible extreme case, you're out $7,000 because it's like the 70 strike times 100 shares. So 7,000 minus roughly 2,000. So that like your absolute worst case scenario is like you're out the $5,000. Um, and that's like the absolute worst. But chances are Coinbase isn't going to go out of business. And in fact, like in 2024, well, if all things goes right and the SEC finally approves like the Bitcoin ETFs, and then there's more regulatory clarity, I expect like good things for Coinbase. But again, like none of this is guaranteed, of course. But that's just like my own personal risk. So let's go over this again. So the stock replacement is your long call and your short put. So you're out $835. Now, if you go, let's go to like the at the time of this recording, there's a October 13th, 2023 expiration cycle. And again, this is just an example. So if I sell a at the money covered call, so that's at the 75 strike, and I'm willing to sell the bid. So I'm only collecting $2.77. So that would be $277 like that I collect. And let's just say, for example, I'm able to do this 4 times a month because they do have weekly options. That brings me up to um, 1108. So again, multiplied by 100, and that's $1,108 on my initial upfront cost of 135. That could be 137% return on the synthetic long position versus like if you just did a regular covered call on if you just own regular stock versus 14.8, which again by itself isn't that bad, but when you compare it to 137%, it's pretty bonkers. But again, that assumes like you're able to collect like the whole amount, and chances are like you might get assigned, so then you had to sell out the entire position, but that wouldn't be necessarily like a bad thing. Because then like the next week you just like do the whole trade again. It could be a little bit annoying, but hey, that's trading. And let's do the same example again, except this time, let's say like you're more conservative. Let's say you want to do like you want to do it out of the money. So you want to do like let's say like around like the 27 delta. In this case, this would be the 80 call strike. Again, so let's say you sell at the bid, and that's $1.08 over here. Again, if you let's say you're able to replicate this roughly um, 4 times a month. So basically one covered call each week. You could potentially collect $4.32. So on 100 shares, that's 400. $32. So that would be 50%, 53% return on your synthetic covered position, or and that's versus like the 14%, uh, 14.8% on just a regular stock. So as you can see, this could be pretty lucrative. But again, that's if everything goes right and the stock doesn't drop too much. So if the stock, let's say for the sake of argument, like the stock drops to 70, so depending on how far, like how much premium that you're able to collect, you might be able to offset like your losses. So hopefully, like Coinbase doesn't. If you decide to do these type of positions, you have to keep that in mind that this is not an invincible strategy. But your worst case scenario is that like you lose whatever you put up front, um, and then like the just your whenever you sell a covered call, you get that upfront premium, and you can offset your cost basis. So like you know this could be like a fun type of trade for you. So like just keep track of your cost basis, and then lower your cost basis by like every time you sell a uh, a covered call. If you're not assigned, that's good, and that you can always like jot down like how much you're gathering premium, and then offset your cost basis that way. So I hesitate to mention this, but you could also do this if you're really aggressive. But I don't recommend it. You can actually use this in most brokerages. They'll offer regular margins, so that gives you about 2 to 1. And then portfolio margin will get you anywhere between 4 to 6 to 1. Uh, but for most beginners, I don't recommend it. Uh, and if you decide to do it, just be really careful. Um, but the reason that I wanted to kind of show people how to do it yourself, because at some point, like when you get to like a really big account size, um, these funds don't work for free, right? Like they have fund managers that are um, that are managing this exposure for you, and so far, like what I've seen is that most of them have like they charge like 1% a year. So depending on like your account size, like that could really add up. And I apologize for if there's any background noise. I guess like some neighbors are doing construction. So the pros of this, like for most people, this is a pretty easy way to get into like some option premium. And then this actually might save some money on fees for small accounts, because like some brokerages they still charge like contract fees on the option trades. And the Yieldmax and Defiance, I like them because they're pretty transparent and like um, what they're doing with the funds. So that those are definitely pros. Um, and then just to highlight the risks again, like there's a like the high expense ratio, and then you don't have any control over what strikes they select. So like when you're doing it yourself, you have more control. Like, do you want to sell it at the money? Do you want to sell it out of the money? If you do it yourself, that's up to you. So you have more control over your returns. And again, like if the implied volatilities for any of these ETFs, if they suddenly collapse, that's definitely going to impact your returns. So if you remember from like the one of the earlier slides, like over time, like a lot of these the distribution rates were fluctuating all over the place, just because like for example, Facebook, it probably wasn't always. If you went back to like 2022, like I'm sure the implied volatility was much higher, and then you could all this would have instead of like just 27%, it probably would have been like closer to 50. But again, because of Facebook or Meta, um, however you want to call them, they like the implied volatility um, changes over time. So you ex you have to expect that these returns will change accordingly. And then also just a small minor thing that these ETFs might not be available on all brokerages. For example, on Tasty Trade, I was a little surprised that I couldn't open a position on an option position on NVDY. So I had to go to another broker. Well, in fact, Mumu and Thinkorswim, they were fine with that. So I just happen to have like a Mumu a trading app affiliate link. But you don't have to use it if you don't want it. But they are occasionally they do offer like a free stock. So if you want to take advantage, I do have a link below if you are are interested. And again, I just want to highlight again just to hammer it home that the yields are not consistent month to month. So you have to expect like the distribution rates to change along with the implied volatility. But if you have like thicker swim or tasty trade, like it's pretty easy to monitor. Like they for example, tasty trade has like implied volatility rank. Right now it's only 23.8, and the overall implied volatility right now for this particular strike excuse me, expiration cycle is about 72%. So it's relatively high, I would say, but not as high as it was in prior months. So I just want to bring these ETFs to your attention because I think this could be a helpful way to just to bring in some extra income. But of course, like it's all up to you. You don't have to do any of this stuff if it seems too complicated for you. So in a future month, I'll probably bring you updates. I'm hoping they're like for example, I'm really excited about the QQQY one. So I'll probably do a separate video like once I get like the actual return and then and show you how I'm kind of like averaging into like um these ETFs because I think they'll make a big difference. Um, Even at the lower end of the cycle, like even if you only get like 15 to 20%, that's still a lot better than what most you know ETF ETFs or just regular paying dividend stocks will give you. So I hope you like this. I hope you can consider liking and subscribing. Uh, and thank you very much for watching. Have a great day.